Hello dear viewers, today I am going to tell you that how to invest in stocks. Step 1, set your time frame. When you are ready to invest in stocks, it's natural to start by looking at how the stock market has performed recently, but investing pros say this gets the process backward. In the short term, the market's ups and downs are unpredictable, so instead you should focus on yourself. What are you saving for and how long is your time frame? Your timeline is key. It's almost impossible to say whether the stock market will go up from one year to the next, but if you can commit to investing for at least 5 years, your chances of making money are very good. And if you have 20 years to wait, you are all but guaranteed to come out a winner. The stock market has never posted a negative return in any 20-year period. According to one recent study that looked at stock market returns going back to the 1870s. If you need the money soon, skip the stock market. The upshot is if you are investing for short term, say to build an emergency fund or pay for vacation, the stock market might not be the right place for you. While the stock market has returned about 8% on average a year in the last century and a half, in about 1 out of 7 years it has lost 10% or more. We just don't even let people put money in stocks if their timeline is less than 3 to 4 years, says David Benson, Chief Investment Officer of investment company the Benson Group. Instead, you should consider putting money into investments like they may not have as much upside but protect you from losses, like CDs or high yield saving accounts. If you are saving for long term, invest in stocks. On the other hand, if you have a long term financial goal, especially retirement, but any goal a decade or more out, you can afford to invest in stock market. While you will almost certainly encounter a bear market during the time you invest, you will also have time to ride it out. The average return for stock market over 20-year periods is about 7% a year, and the worst its over returned is about 0.5% a year. Of course, even with a long time frame, most investors don't put their money in stocks. They round out their portfolio with bonds, which can help smooth returns over time. Since bonds tend to be less volatile than stocks and often see their prices appreciate when stock prices fall. Owning bonds alongside stocks is especially important as date of your long-term goal draws near, and you cease to be a long-term investor and become more of a short-term one. There's more on ways to get help finding the right mix of stocks and bonds below. Step 2, decide how much risk to take. Because you have time to invest in stocks does not mean you have the stomach. Pullbacks can be sharp and swift. In fact, the stock market has seen a temporary decline of 10% or more in 10 out of last 20 years, according to stock trading from Schwab. One time, the notorious Black Monday of 1987, stocks fell 23% in just one day. Needless to say, even if you have the time and understand intellectually that stock will eventually snap back, you still need to think carefully about how much risk you are really willing to take on. Historically, bear markets, typically defined as a drop of 20% from a recent market high, last about 9.5 months. A stock prices fall by an average of 36%. While that's a relatively short time frame, studies have shown that many investors often tend to lose their nerve and sell. Mistakes can be costly since selling at the bottom of a bear market typically means you will lock in your losses and miss out on the next run up. Each year, fund researcher Morningstar tracks the difference between what investors could have made if they ignored the stock market's ups and downs and invested consistently, and what they actually did. They found that over the past decade, investors have missed out on about 15% of their potential stock market profits by making ill timed trades. The upshot is that most investors will want to own some bonds alongside the stocks they hold to help absorb market shocks. The table below shows how adding bonds to stock portfolio affects performance. Find the right mix of stocks and bonds for you. Here is the table of that. Step 3, decide your investing style. Getting into the stocks market looks different from different people. While some people view buying stocks as just that, purchasing one or more shares in a company, choosing what and how to buy is an important step in the process. Picking individual stocks could give you big gains or big losses. Putting your money in funds is safer, yeah, but you have to watch out for fees. Read more about your options below before you dive in. Individual stocks. Many new investors buy stocks by setting up a brokerage account, which, once the account is funded, will allow you to buy and sell shares of publicly traded companies such as Apple, Coca Cola, and thousands of smaller concerns. How to search individual stocks? A lot of investors find stock picking rewarding, but doing it right is a lot of work. People tend to buy stocks of companies whose brand names they recognize